demand for U.S. product. And then you have the EU, Russia, and Ukraine. They kind of featured into more of a dry parameter or structure there as they work through that. And, you know, the rest really comes U.S. based. The derecho that hit the U.S. was another key variable that caused dynamics there, coupled with a flash drought in the Western Belt, particularly Nebraska, Western Iowa. That was a focal point. And the rest is history. USDA threw a curveball then in the September report with their stocks, both corn and soybeans coming down substantially. South America endured one of their driest start that they'd seen in a long time, 30 plus years, and then the decline of the US dollar. So it's not just one event we can really kind of account for this issue. But what's important is this right column here, what's ahead. When you look to South America finishing weather, that's going to be a big dynamic right now. Argentina's dry, and that's allowed a boost of the markets here as of late. The U.S. planting going to be a big feature here over the next 2 months, 3 months, as we zone in on how many acres will the U.S. plant to corn, to soybeans, and what's going to be that structure. The U.S. weather, I think that's a dynamic. Right now, we're working on our monthly newsletter, and right now, the CFSV2 and NMME model are continually pointing to a little bit by little bit more drier undertone as we work into the summer and fall structure. Now, it is tough to forecast 2 weeks out, let alone 3 to 6 months out. So please take that with a grain of salt, but just understand the general trend is for a little bit warmer conditions. China, the EU, Ukraine, guys, they're all important because they make up a big variable. Obviously, China demand has been a big push here in the U.S. We'll see if that continues. And then the unknown black swan event, it's something we've just got to kind of watch over our shoulder for any given change. Even this last week, African swine fever starting to make a bit more of a headline over in China. So that's something there too we'll have to watch as we work ahead. Obviously, U.S. dollar index and impacts of the currency valuations, and then world production. The cure for high prices is high prices. And when we come back and review here a year from now, we're going to have to understand that as we see higher prices, we're going to see areas that maybe haven't been as big in years past step up with greater acres. We'll see Brazil and Argentina step up with greater acreage. So that's just something we've got to understand. Now, the uniqueness of today, we've got a crop report coming out today. And the forecast right now is for corn carryout to be 1.470 out of this report versus 1.502. So that's our finishing stocks that we'll finish with, as of September, according to USDA. There is a slight reduction. What shocks me is that, the market was down around 1.3 in the last report for a forecast. So we'll see if this kind of shocks the market a little bit, if we can get a little lower than that off of some feed use increases as well as exports. Time will tell on that. We'll find out 11 o'clock. Soybean carryout, 117 million bushels is where we stand based off the estimate coming into the report. Last month we were at 120. So we'll see if USDA gives us any surprises there or if they've just give us a modest decline or increase. But the market's expecting a very small decrease in soybean carryout. And wheat carryout forecasted at 839 million bushels. 836 is what we had last month, so a small increase there. But again, the market not really grabbing onto anything too exciting here in the report today at 11 o'clock, but we'll have to watch closely for details and see what USDA actually gives us. Now, how we market, we try to take a 4-step approach to marketing. Create our break-even analysis. The most important step in this whole process is understanding where you can make money or where you can't. Focus on the price, basis, and carry. That's so important. The next step is we take a 4-pillar review: fundamental, technical, seasonal, and money flow. We like to set the structure off a market based off those seasonal type focal points, but then obviously the fundamental, technical, and money flow give us a lot of details around that circumstance. Then we create the marketing plan, and we're going to step through that little base today and then update and adapt that marketing plan as we work through a market year. So let's get right into it. USDA has what they call an outlook forum. So when we look at the corn market based off that outlook forum, USDA is saying based off new crop planting of 92 million acres this spring, a 179.5 yield, good demand numbers, ethanol at 5.2, feed use at 5.850, exports at 2.650, that results in a 1.552 billion bushel carryout. Now that's a tighter carryout. The 1.5s to 1.2s, we tend to see $6, $5.97, $5.17, $4.54 type highs for the market, and harvest lows between, I would call it more $3.58 to $4.10. That's kind of the framework of which a market we have based off of 1.5 carryout. Now, if we kind of take some Van On planting numbers of about 91 million acres, use the 179 yield, plug in USD outlook forms, we come up with about a 1.3. If we would come in here and have any problem with yield or production at all, and you take that yield down to a 173, folks, that's an 802 million bushel carryout. The last time we were down in the 800 million bushels for carryout, we were trading $8.49 corn. So you have got to understand the dynamics can get very tight this year because of where we're coming in. On the flip side, if we would have a record yield, we'd be back to a 1.8 carryout. And 1.8 type carryouts, guys, result in 318, 358, and 343 type harvest low prices. So when we're trading 470, 480 right now, that's a lot of risk if we went down to those prices. So again, the dynamics are just a little bit greater to the bull side than what we've seen in years past. But there are circumstances where we can create a bear situation and be stuck with lower prices at harvest. So this is not going to be an easy realm to really navigate as we work through those circumstances. Now, when you look to the US and world stocks, you can see that the US has downticked. But in the world numbers, folks, I want to make an important point here. It doesn't look like we're as tight in the world number. 67% of that world inventory is held in China. So that's a bit of a concern. They are a non-exporting nation. If you want the proof, this is China's import versus exports. They import in. Since 2009, they've been importing in grain. Okay, what you've got to understand is the dynamic of this year versus last year. The largest imports China has ever had was about 7 million metric tons. This year, they're going to import in around 25 million metric tons. So we've got to ask ourselves, what is this boom in China? Is it the phase 1 trade deal? Is it African swine fever? We're being over that and we're expanding hog herd. Is it that the inventories they claim to have, they don't really have? You've got to make the call, because if we come in here and falter demand next year and we're only having 7 million metric tons of product demand, folks, that's going to put up some pressure on this market. What do I mean by that? USD is forecasting a 2650 export number. If China isn't present like they were this year, that number's going down. So when we look to China yield and production, China's production is going to be just as important as the U.S. production this year as to whether or not, in my opinion, they're buying a big chunk of corn or not. Now, when you look at the export sales year over year, basically you're looking at export sales that are off the charts. Okay, that is great. But the difference between corn and soybeans is we haven't shipped the corn product yet. And what hasn't been shipped can be canceled. So USDA is trying to be very cautious to make sure China actually takes this corn crop. Ethanol profitability has been rather tough, but that has been improving here in the recent months, and that's encouraging to see because we need a strong ethanol parameter to see good demand and a good base of corn price. The investor, though, the investor is rather long. Managed money and index funds are sitting rather long these markets right now, so you've got to be aware of that. Folks, the ship is really leaning to the bull side right now. So if we see any change of circumstance around that could bring in a more negative or bearish tone, again, that could cause washouts across this commodity spectrum, in grains particularly. Doesn't mean it has to happen. You just need to be alarmed and aware. When you look to the July corn seasonal, folks, typically we tend to see a high around this time frame. The 5-year and 15-year charts tend to say, these are the blue and red lines, tend to show a pointing downward slope here for what's ahead into April, May, and then a bounce back in June. This is where we're currently at on the black line. So if we see the markets decay, that's not uncommon. That's the likely trend. But they tend to bounce back. In new crop corn, April, May, June, and the first part of July tends to be the strongest parameter for a seasonal high. Of the last 18 years, 9 of our seasonal highs, so half of our seasonal highs, have occurred in the April, May, and June timeframe. Folks, you just want to focus some marketing into that April, May, June timeframe is what we're trying to preach there. Now you might say, what are the price counts, Jim, if we're looking at a bigger feature here? And folks, you're looking at areas we're at right now, and then to mid-6 level, 626 to be exact based off the monthly, and then 768. Those are the big price counts that if we can get going here and maintain this corn rally and get some circumstances around planting or summer weather that are bullish, these are the price counts that begin to come into play. From there, if we dissect them more in detail, July price counts, guys, this 517 to 550 level is a third area type price count. There's reasons we're consolidating here because, again, this is what the Fibonacci extensions forecast us to struggle at. The next area of major resistance, without looking at anything else but a Fibonacci extension, gives us a fourth price count around 692. In my opinion, it's going to take a significant weather event in the U.S. to achieve that type of price count. So you've got to start to just manage your risks and say, hey, if we don't get a weather problem this summer, we're probably going to falter here at around this level. If we get a weather problem this summer, we're likely going to target those high $6 numbers. You've got to begin to estimate how you manage those risks in between. Now, we've got other price counts in here using different systems, but I think it's just important to kind of see where that structure is. Now, in new crop, we feel like we've got the potential to get to this 497 area near $5 level, and that's going to be a third price count. The next price count after that is 617. Now, we've got other areas in here. We've got a 523 price count in here off of another system we use to generate these type of price counts. But these are at least giving you an inflection area to focus in on. And we're here in old crop. That's the reason we're consolidating. We've got potential to 497 in new crop. And then the price counts get rather large, 617 in new crop and 692 in old crop. And folks, if we get a summer weather problem, those price counts could be in the cards. If we don't, you're going to wish you had done something here at these third price counts. So try to navigate those risk structures. What we're doing is using trailing stops to help us navigate those. Now, if you look at the history of the bull versus bear overlays, these are the bull overlays here, and you'll notice that we kind of consolidate in here April, May, June, and then all heck breaks loose as we work into mid-June, July, and August. Oftentimes, if the crop's good, we can see it falter, as we see here in the green and pink areas. You can date those back to 2008 and 2013. In the bigger bull years, 2012, 2011, you can see that we try to make those August highs. In the bear years, most highs have been achieved by the middle of June. You can see that stiff fall off there that we tend to see. So just keep that aware. Basis levels are strong. We forecast basis levels could narrow here a bit more over the coming few months, and then we look for it to widen out pending circumstances around are we in a drought or are we not. Obviously, the dynamics could increase if we're in a drought, but if we're under the circumstance of a normal crop year, crop looks pretty good, we could see that basis begin to falter. Where we stand, we're at 90% marketed. We see price counts at 551, $6, at 692, and then 750. Folks, those are taking all circumstances into consideration. So what we're telling guys is focus in on this 550 level. If we can break out that $6 level, in our opinion, stiff resistance unless we get weather. If you're looking at if you're a weather bull and you just think this drought's going to prevail, then 692 to 750 is areas we could go. That's where you want to take your focus. We really think producers need to zone on this 550 to $6 level to have points of accountability. In new crop, the areas of resistance are this 460, which we are now above, 460, 497, 523, and then 617. These are the areas you're going to want to focus in on for new crop marketing. We're 30% marketed. That's the area that we think are of importance. And we basically will say, hey, until we get to April, or unless we get towards $5, we're not going to do much here because we've got a 30% base. But if we get to 497, or if we get into that April timeframe, we need discipline, and we're going to try to use trailing stops to hold that accountability. As you look to soybeans here, the soybean dynamics are a bit different here, and we can run through these pretty quick. If you look at the soybeans, both off the Van On planting and the Outlook Forum, folks, soybeans are getting tight. Okay, you've got to understand that. 90 million acres at a trend line yield of 50.8 with good demand results in 145 million bushel carryout. Folks, we don't get out of this hole we're in. And the last few times we've had 140 million bushel carryouts, again, we were looking at $14 to $18 type price structure. Okay, that's reality for new crop beans as well as old crop soybeans. In regards to old crop, it depends on what USDA gives us today here. But when we look at the new crop S&Ds, folks, if we use a 90 million acre planting, a 50 bushel BPA, good demand, we come up with only a 45 million bushel carryout. Folks, 45 million bushels, if we have any hiccup at all, turns into a negative 311. We can't have a negative carryout number at the end of the day. That means we don't have product. So just realize these bean dynamics, when you hear conversations around, hey, if we have a problem, beans could get to $20, that's no joke. In all seriousness, those are the dynamics we've got right now. Now, can demand be a miss? Sure. If demand is a miss and China's isn't here and we come back to 1920 numbers, well, yeah, that can build carryout. There's a lot of moving targets. Just realize based off the circumstances we know today, there's a lot of dynamics around beans. Now, does that mean you shouldn't do marketing? No, that's not what we're saying. What we're saying is understand the dynamics and make sure your marketing allows for upside potential. If that means small staggered sales at key levels, that means small staggered sales. If that means having ownership against sales, that means having ownership against sales. Now, when you look at the ending stocks, you can see that domestically we're tight, and even worldwide we're nearing the 2012 tightness. The one problem in beans is we're more diversified than we were here back in 2012. The dependence off of Brazil and Argentina has become far greater for China, and that's taken a little bit of edge off the U.S. markets when we're into those more average years. Just keep that in mind. U.S. soybean crush, folks, there's no question, ifs, ands, or buts about it. Our crush demand has been strong. The exports have been strong. You can see both our sales pace is near 100 and our inspection pace, what has been shipped, is well above average. What that means is, folks, you can't cancel what has already been shipped to China. So we're in a pretty healthy type environment here that we can lean on to some degree. Now, when you look to manage money, they've been lifting here despite being still rallying. So you see where managed money has lifted some positions, index funds have sold out of positions, but yet we still have a healthy bull trend. That's encouraging to see. And that just allows that potential that they can buy back in here as we work ahead. Now, the seasonal tendency is to flatline, to fade a little bit here, and then to really boost back up June, July. And so those dynamics are a little bit later here into August on when we can see potential price increases. You can see that 5 of the last 18 years, the high has occurred for new crop in the second quarter, but 7 out of the last 18 years have occurred in the third quarter. So you just want to make sure you've got a little marketing there into that July, August, and potentially September timeframe. You can see that not all years is at the best area because, again, generally we see May through July being that core area, but August has a way of bouncing back, and if we're dry late this year, that's when you're going to really see the dynamics in soybeans. Price count-wise, 1464 and 1675 are price counts that are in play. If you break it down on our Fibonacci extensions, we're into consolidation zone between this 14 to 1450 area, folks. That's a third price count. The next price count after that is 1936. If we don't get acres this spring, if we have more demand out of China, if Argentina has a problem, or if our weather is not good or favorable to production this year, guys, that's when that 1936 comes into play. If we can dodge all those bullets, we might see a high $14 to $15, but I think we're going to have dynamics here as we work ahead. For new crop, 1220, 1230 we're into. We've got a 1283 next price count, and then we've got price counts that get into the $14 and $15 area here. Folks, I would not rule out that new crop beans find their way towards $14 at some point this year. From there, it's going to be a big dictator off of weather. So the dynamics are a bit more bullish than we've seen in some time, and we'll just need to keep that in mind as we work ahead. When you look at the overlay chart, here's the bull years, here's the bear years. You can see 12, 13, 11, and 8 in here. I want you to look at this consolidation point. So for April, May, and June, notice how we kind of converge on near $13 here, give or take. And then from there, when we hit about June 1st, this market either explodes or really begins to fade. Okay, you've just got to realize that June timeframe is going to tell us a lot. So our expectation is that beans consolidate similar to what they did. Look at where we come from many different areas, consolidate in, and then blow up or fade based off many different areas. Just realize we're entering that consolidation phase here. And also realize in the bear years, if we get a good crop, most times by June 15th, the market really falls off in the bear years. So you've just got to keep that all into mind and structure. Basis-wise, I look for basis to kind of flatline here. I think demand out of demand for China will come out of South America as we work ahead. Whether or not they'll continue to buy, I think things have slowed already, and they should because we don't have a lot of product. We'll see what USDA gives us today, but I look for basis to flatline. I look for bean acres to be planted this year. Whether or not we finish the crop will dictate a lot of new crop. And I would say have a small base of new crop basis locked up at better than average prices, but be careful getting too much. You don't want to get caught in a drought with a lot of basis contracts. Where we stand 90% marketed, we're trying to see if we can't get between this 1450 to 1650 area to kind of get towards 100%. We're trying to hold out for that mid $16 area to make our next move. In new crop, we're 30% marketed. What we encourage producers to be is baseline. We got a great February crop insurance at 1187. When you couple that with 30% marketed, let it tick and then evaluate from there. The next step is to focus into May through August on saying, hey, 10% per month, I'm going to stagger my seasonal approach there and really try to build into our marketing plan from there. With that, we're going to touch on cattle and hogs here for the last 5 or so minutes, and then make sure we don't have any question there as we work through this. So when you look at the feeder cattle seasonal, folks, we're kind of in that time frame where we see a little slide here, April into early May in the feeder cattle. So be alarmed of that. Do we tend to bounce back? Yes. By the time we get into that fall time frame, it works out pretty well. But for those spring, feeders, you got to just be attentive to that. Live cattle, same token. We tend to see a setback here, flat line into May and June, and then, kind of that next push in July there off the seasonal. So just ask yourself where your slots are. When you look to the feeder cattle price counts, folks, we continue to struggle near this first price count, and we'll continue with the strong corn market to struggle between first and second price counts. So between 146 and 152 off of front month feeders, I think you got to be focusing on marketing in that area. In regards to live cattle, focusing in between 126 to 132 off the April and 124 to 129 off the December is our focal points. Have your calls in place in case something bigger happens, but first and second price counts in cattle is really where we'd be focusing. And again, that's 126 to 132 April, 124 to 129 off the Dece. Weekly dressed weights is a big problem. You can see that our cattle have gotten heavy here as of late, and that's causing some of the cash pressure we're seeing on these heavy cattle moving into market. Box beef cutouts has been positive, but slid a little bit last week, nearly $9 in choice off the highs now. And in regards to our managed money holding, we've got funds that are holding a pretty good cattle position. Okay, it's not like they're short by any means. It's not like they're near zero. They're holding some long in here. So if they see a reason seasonally to, fade these markets a little bit, we could see that. Our cattle Rex rate now is realized that exports have been strong. We had a miss about 2 weeks ago, but if we can keep that cattle export market strong, that'll help. Domestic demand has been strong, and if we can kind of get these vaccines out and rolling, we hope for a very strong summer demand, and that potentially could create some holes and allow some possibilities to really kind of come in there. For live cattle, first quarter, we're 50% marketed, second quarter 40, and third quarter 10%. If we can get up there to 129, we'll focus more on that third and fourth quarter there off of those December contracts. But feeders, we're 50, 30, and 0, really focused in on this first and second quarter, hoping to get to that second price count there in those feeders to get up towards around that 70 and 50 respectively in the first, second quarter. So first quarter's coming to an end very quickly, and hopefully we can finish up towards those highs. In regards to the hog seasonals, folks, you've got to realize that we're coming into a seasonal time frame where we tend to fade. So by usually this April into May time frame, we've seen a pretty stiff decline here in the prices, so we need to be attentive to that here as we work ahead, that we can be into that parameter. We're into third price counts. We think this is a big marketing point. Fourth price counts are all the way up to 114, so focusing on some marketing and risk management here. If you want to allow for upside, that next count's 114. Whether we get there or not will depend a lot on the domestic situation and China demand with African swine fever. But what you've got to understand is if we ever have African swine fever stateside, folks, that could be a mess both in the grains and meats. So we've just got to be a little careful here and make sure we market when profits are present. Weights are doing okay. In regards to our structure here, we're looking at daily cutout values that are also holding in there. I just need to kind of pause something here quick, my apology. We're looking at those cutout values that are above average, which is encouraging to see, and managed money is holding a pretty good position here. So we just need to realize those risk structures. Now, with the third price counts, you can see we've got more aggressive first and second quarter, 70% and 60% market, third and fourth, 30 and 20. And with solid exports, third price counts, and weights that are a little bit above still, we think these marketing percentages are important. Maybe we can get to 114. We don't know. But what we do know is profitability is present. We're at some great price counts and do not overlook those. So with that, I just want to kind of thank you for coming in here this morning. We were asked to allow for the last 5 minutes for questions. It's a quick run through on a lot of important topics. But I think the biggest thing to understand, folks, is let me ask you, what is your plan? What are you doing to take the marketing realm by the horns and really dictate what happens on your farm. I think it's so important that you've got your structure, your base guidelines, and that you can implement a plan. That's something we and many others can help with, but it's something you can also do on your own, and we'd encourage you to really focus in on. We got just a few key products we're not going to touch a lot on, but if you've got any questions or would like a 2-week trial, you can email me at emter@vanonco.com. What I'd like to do at this point is open it up for questions here for the last couple of minutes.
Thank you so much, Jim, for that wealth of information. It's fortunate that we're able to record things like this because it's so much information to go back to and incorporate that into our plans that we have in place. Thanks so much for that encouragement to make sure that we have a plan and that we don't just set it on the shelf once we have it written down, is that it becomes an active plan.
Absolutely.
Any questions from others in the room? Hearing none right now, Jim, I thank you so much for agreeing to join us for this conference and for the amount of information you're able to share with us. I encourage people also to continue to follow. There's so many different areas that will change the markets, and we need to stay in tune to that. Jim, any ideas as information flies at us from so many different directions? What's the best way to hone in on some of that to be able to evaluate the strength of our plan?
Well, yeah, I think that the whole key is having a base foundation. I mean, when you look at the first slide, kind of on our whole risk management approach, what we try to do with our clients is really come back in here and determine break-even analysis. That is the most important first step a producer can do, is know where he or she is making money or losing money based off circumstances. And we've got systems that we build. There's a lot of them out there. You've just got to find a way to determine on your farm where you're making and losing money. The second step then is to create base foundation. And we like using the seasonal histories, kind of looking back. And that's why I like those base overlay charts. So if you could really take some time and watch this back, go look at those overlay charts and go look at where the tendencies are for a market to kind of peak and struggle and where do they excel. I think those are really a key for producers to focus in on and make some timeline decisions that say, hey, historically, if I'd make decisions April, May, June in corn and May, June, July in soybeans, I'm usually getting the top end of the price structure. So kind of creating a timeline of how you want to market is the key, and then implementing the plan, realizing that, hey, just creating a timeline a year in advance is like trying to forecast the weather 6 weeks out. There's circumstances that are going to change a forecast, okay? Your ability to adapt to those are so key. And so what we try to do is really evaluate our trigger points, and what we call those are stop-in points or marketing targets. Are we trying to get to a level to sell, or are we trying to use accountability against a sale? And what that means is, hey, if we're trading 450 corn and I don't want to let 430 slip away, there's tools that you can use that will not execute a marketing plan unless you break 430. And use those tools to dictate and help you ride waves higher, but have discipline if the markets falter. And then just realizing your risks within a marketing plan. If you can come in here and create that base structure, create a method of institution or of implementation, and then have accountability measures around that, folks, your marketing will improve exponentially from our vantage point. Any other questions at all? Last call for any questions.
So thank you again, Jim. Just want to remind people that the other sessions are beginning. So if you'd like to attend in a different session, feel free to leave this room, and you will get assigned into another breakout room. But I will remind you again that these sessions are being recorded, and so we can get back to listen to this again or get in touch with Jim. He has his number and his website listed here on the screen. A great resource to bounce ideas and questions off of. Thank you again, Jim. Thank you all for coming. Enjoy the rest of this day.